Hello, I'm Emily Barker. Welcome to Media Vision, a new series of member broadcasts from Media Super. Today we're looking at investment strategies, both old and new, and in particular some of the directions Media Super are taking to smooth volatility and help maximise member returns. We're joined by John Glass, Chief Investment Officer with Media Super. Dr. John, many Media Super members who actively read the financial press will have seen a number of reference to after-tax investing. What is this and how does it work?
In the superannuation environment, members invest through our portfolios, and those portfolios attract fees and taxes, and the taxes are on capital gains and income. And so it's important for us in managing members' money to try, where possible, to get the best after-tax returns on behalf of our members.
How will this benefit your members?
That is what they are credited with, that's the return that they get, and so it's good for them to deliver that kind of after-tax outcome that's beneficial to them.
I've been hearing bits and pieces about high-frequency trading. How does this impact the fund and your members? High-frequency
trading has emerged only recently in stock markets around the world, and to put it simply, it's an activity where trades are executed in very, very small lots and at very quick velocity and high frequency. They even use the term nanosecond, which I believe is 10 to the minus ninth of a second. These high frequency trades could be construed as being, in some sense, not quite in the interest of our members, who are long-term investors, who we try to build portfolios for that work for decades, and the congruence between a nanosecond and a decade is not quite apparent in my mind. And so this is something we think about quite a lot at Media Super.
Investment terms like passive and active are used commonly. How are these relevant?
Passive is quite relevant in what we've been talking about, both with regard to after-tax investing and high-frequency trading. Passive investing, which is a form of investing that we make use of, is really one that tries to minimise the amount of turnover in the portfolio, in other words, the amount of buying and selling, so that a particular index can be faithfully adhered to. And so when we think about after-tax investing, when we think about high-frequency trading, we think about whether our portfolios are well tuned to this new development, and are we in fact getting the best for our members in an environment where trading is becoming faster and more furious all the time.
Why do funds use both passive and active management?
Because it makes for a good mix. Passive management tends to be much, much cheaper than active management. Active management, although desirable, cannot always be found in every sector at every time. And so funds will often mix and change the mix of active and passive.
And how do you maximise the returns for your members from passive management?
The thing that you try to do is identify an index that you're comfortable with, an index being a broad representation of an investment market. Then you get the manager to passively replicate that index and deliver its returns. And then there's a level of certainty of outcome inside the portfolio as a result.
And then how does this relate to fixed interest in bonds?
Yes, the connection is not obvious at first blush, but the fact is that we use passive managers in our fixed interest portfolio. We also use active managers. And what we've been thinking about lately is that in a world where interest rates are extremely low, and if you examine charts of interest rate movements over long periods of time, you'll see that interest rates have been declining for decades. They're at a point now where it's hard to see that they can go a lot further downwards. It's also possible they could start to flatten and reverse and go up. And let's remember the fundamental principle of fixed interest investing or bond investing. Interest rates and the price of bonds move in the opposite direction. So a rising interest rate market can be quite threatening to fixed interest investors. And so we are thinking about other ways that we can invest our fixed interest money that could protect members in that eventuality should it occur.
What are the different types of bonds Media Super invests in?
We invest in government bonds. We invest in company or corporate bonds, and we also invest in some floating rate securities, and this is an important distinction. Some bonds are created at birth with a fixed interest rate. Others have interest rates which vary with the ambient environment that they live in. And so we have a mixture of those in the portfolio, and it's that mix that we are always thinking about and looking at through the lens of the direction of interest rates in the future.
It's all about getting the best for your members.
It is indeed, and about thinking what the member wants and how to communicate that back to the member in terms of what we achieve on his or her behalf.
Thanks, Dr. John, for the update. And of course, for more information, you can go to mediasuper.com.au.